So we finished the week with a 5-day losing streak, down every single day this week. Not quite as bearish by the end of the day as we could have been. So I'm going to break down the technical outlook today using the market forecast and other technical indicators. What should we expect next week now and the week after that? Are we finally getting the pullback? Have we had the pullback? That's what I'm going to discuss today. I'm also going to break down what's driving this price action and then another look in the cyclical area, another sector of the market that's not doing so well, and how we might be able to take advantage. So let's go ahead and get started. Today is Friday, March the 8th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's get started with the S&P 500 with the market forecast indicator. You can see we had a down day today, so another down day, small down day, after opening up a little bit lower, only being down 6 points. This is 1, 2, 3. Well, if I zoomed here, let's get to like a 6-month chart. You can see 1, today's a down day, 2, 3, 4, 5, 5, 6, 7, 8 out of the last 9 days have been red, which means it closed lower than the previous day's close. Now today's a little different in that we have an open body on the candle stick here, which means that we closed higher than the open on SPX. That's different. We've had 3 of those during this losing streak. Well, 2 of those. This was an update there. So, regardless, the intermediate posture remains weakly bearish. It is below 80 and falling, so it's bearish. Remember, if it's above 80, it doesn't matter what it's doing, it's strongly bullish. Now, when you can't go from strongly bullish to strongly bearish. You go from strongly bullish to weakly bearish, right? Same thing like on a football field, right? If you have the ball on the 1-yard line, you're in a strong position to score. If you fumble it and give it to the defense right there on the 1-yard line, you don't have the ball anymore. They do, but they're in a very weak position to score. So it's hard to go, in the same position to go from strong to strong, and that's same thing here. We've gone from a strong bullish posture now with the falling below 80 to a weak bearish posture. That weak bearish posture resolved this really bearish short-term sentiment that we've had this past couple of days, where we've pulled back, and despite the pullback, we still haven't even dropped to the 23% Fibonacci retracement. I tweeted that out this morning, how we haven't dropped to that 23% retracement level yet. So keep that in mind when we're talking about like how bad of a deal that is. I mean, we've hardly pulled back at all relative to the 500-point gain essentially that we've had to the upside, near 500-point gain that we've had to the upside. So take a step back and don't worry about. I mean, yes, it's 8 out of 9 down days. Yes, it's 5 days in a row, every day this week. But it's not that big of a deal, right? If you think that's a big deal, then you should be up in arms over how much we rallied, because we rallied. That was a big time rally, but nobody really complains about that. So if you're not going to complain about a 20% jump off of a low point, then you shouldn't complain about a less than 23% drop from a high. Other than the fact that if you went all in on some bullish positions right here, then yeah, I guess you would be complaining and you'd hate life. But if you've been listening to these videos and attending our classes, you talk about, yeah, you can still make bullish positions here, but they should be really small. In the event something like this week happens, it doesn't impact you very much, all right, and having some good balance as well. The last trade that we did on Wednesday was a bearish trade, and we can start to balance out positions there. So short-term sentiment bounced up because we came off of the low of the day. You can see the same thing on the Dow, though we were below the moving average there on the Dow Jones. You see how we kind of bounced back up on the short-term sentiment. Same thing on the Nasdaq Composite off of the low of the day. A little bit of a bounce, and then finally the Russell 2000. All of these indexes showing bearish postures, all of them showing bounces in the short term. Obviously a bigger bounce in the large cap stocks than in the small cap stocks. Remember, the small caps are what's kind of led the way here to the upside and to the downside as we've gotten going. So the fact that we are not bouncing up as much on small caps would suggest that maybe we're not done with the pullback, right? We're not going to drop down to these lows every single day, right? We're not going to have, even though the Dow Jones transports have had 11 days, is it 11 I saw? 11 consecutive days to the downside, which we haven't seen since 1972, which we've only seen during the Vietnam War and during the Great Depression. Those are the only other times that we've had bigger than a 10-day losing streak on the Dow Jones transport. So pretty significant that it's down as much as it is every single day. So we can drop down to this 2640 level. That's where that's where the Fibonacci retracement zone is, the top end of it at least. That would not be that big of a deal. It's where the 50% Fibonacci fan would cross over just after March expiration. That would not be that big of a deal, but it would, be a relatively sharp decline, about 150 points or so decline. And again, small potatoes compared to the 500 point, I guess you'd say 470 point increase that we had to the upside. But that's kind of where you expect us, if we are going to kind of go up and down here with more of a downward decline, by March expiration, you kind of expect that we'll probably hit into this area where those fans are intersecting. See, we hit some weakness here when the fans intersected on the rise, right, on the other retracements, the blue retracements here, which represent the retracement zone on the bounce back up. That's where the 62% fan crossed over the 50. See, here's the 62% fan crossing over the 50 would be way over here. We'd have to add some more time over here to the side. That would be up in, so there's your 62% fan. There's it crossing below the 50. That would be in this area again, right after right after March expiration. But more than likely, we'll probably come down into this 2640 or even just this 23% level, and then bounce off of it and start a new intermediate move to the upside. That's what we expected. That's what we're getting right now, and the fact that a lot of people are going nuts over how many down days we've had, and they didn't go nuts over how many up days we've had. That doesn't change our expectations. So again, you can kind of see we probably should have pulled back right here and formed a new low point over in this area after we hit that resistance, but we didn't. Right? We continued higher on hopes of a trade deal that still hasn't come to fruition, but those hopes pushed things up higher, and the lack of hope has pulled things back down. It's basically as simple as that. And plus, you've got global slowdowns, and European Central Bank, as dovish as they are, the recession that's going on in Europe, and the weak economic trade data that we had out of China, among other weak data we've had in China lately. A lot of that is kind of starting to weigh and put more pressure on stocks than the lift it's getting from those hopeful trade deal reports. Now, before we look at some more charts, a reminder, subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me that you got something out of the video today, and more importantly, it's a way to tell me you want us to do the video again on Monday. Right? Quick, easy way to give us feedback. You can do that right now while you're watching. Also, scroll down to the bottom and comment what stood out to you in today's video. Let me know, let others know that come to watch the video by commenting in the comment section below. Also, join our daily market outlook email list. Remember, Fridays you get the daily clusters on the S&P 500 as well as the weekly clusters on the S&P 500. So there's a link that's popping out there in the top right corner of your screen. Click on that link up there to subscribe. Also, follow me on Twitter in between videos for content that I post out there in short bites. And also join our market outlook community that we've created on Facebook. Also, remember, while you're watching the video, you can also like our daily market outlook tweets on Twitter as well as our Facebook posts. You can do that really easy right now while you're watching. Click this little heart below the video. That opens up your new window. You can like it there, and then click this image that takes you to your Facebook account, and you can like the market outlook post, today's market outlook post there. Remember, you can also share it with people too. Those, you do those two things. Another way to give us feedback. Also, it's another way to let those social media accounts know, or platforms know, that you want them to keep pushing our stuff to them, and it also lets them know that this is good content that they should promote to other people that like this type of stuff. Quick reminder too, over here on the right we have our calendar. I have my Q&A session tomorrow morning that we usually have on Saturdays, and the next week back to our normal schedule with me back from vacation. Back to our normal schedule here. These are two of Brandon's very popular classes he teaches. If you want to see the rest of our schedule, click here, as well as all the recordings, archived recordings of all of our previous classes. Alright, so back to the charts. You can see how bearish this weekly candle is. A really big time engulfing pattern here, and semi, engulfing these past 2 weeks, and a little bit of a dark cloud cover from the week prior. Didn't quite get to the halfway point, but you get the idea. It's a pretty bearish candle after a couple of kind of neutral candles. When you look at it on a Hakinyashi, and I tweeted this out this morning as well, or late last night, that's a transition candle, right? When you get after you get pretty big bodies and only upper shadows for weeks, then you get a transition candle with a small body, very small body on the Hakinyashi. Now remember, the Hakinyashi is a little different than a normal candle. The open is the open, or the close. The open's different than the open, right? The open is the midpoint of the prior candle's body, right? So you can kind of see how where that's set up for this week. It's the midpoint of the prior candle's body. The close is the average of the actual week's open, high, low, and close. So you average those four values together, and then you get the closing value of the Hakinyashi. And so when you get that small body there, so that doesn't really move from the open, but you get an upper shadow and a lower shadow, so that represents the range. The high and the low represents this week's range. So about 94-point range there on SPX, coming after a 68-point range. Remember that the open isn't necessarily the low of the week, right? The open is the midpoint of the candle. The actual of the week might actually be higher, but when you have an upper shadow and a lower shadow, that is the actual range of the week, the high and the low of the week. So pretty big range, small body. Again, only on the Hakinyashi, not on the regular candlestick. It was a pretty big body on the regular candlestick. That was an engulfing pattern. But that's a transitionary candle that can lead to a reversal sign. You can see other examples of that, small bodies. Doesn't matter if it's red or white, small bodies and upper and lower shadows. Same thing on the downside. See, there's your transition candle when we reverse from the downside to the upside. So that's the expectation. Now here we didn't bounce back up because of the FOMC meetings. We actually turned back down and had a few weeks to the downside here. So nothing's ever 100% in technical analysis, but you can kind of get an idea of just how bearish that decline was in December, because we probably should have bounced considering the types of candles that we were getting those couple of weeks. So we did reverse there. Are we going to reverse here? Well, we would expect that we would, based on the type of candle that is. You look at the green arrows, the 3 green arrows, and you can see we got 3 red arrows. Now usually in bullish trends, when you get 3 red arrows, that sets the low point, right? See, there's 3 red arrows. It sets the low point. Now we went a little smidgen below, but it pretty much set the low point and we bounce. Here's 3 red arrows. We set the low point and we bounce. Here's 3 red arrows. We set the low point and we didn't bounce, right? That's where the trend changed. So we'll see if that ends up being the case. If we are setting the low point, here's 3 green arrows on the downward trend where we set the high point and bounce. Here we set the high point a little bit higher and then move to the downside. So again, probably should have bounced here. That's the whole idea with the mess of the FOMC and all that, and the trade tweets from our president. So are we going to set the low point here and bounce? I don't know if necessarily this will be the actual low point, but I do think at some point in time after we set the intermediate low point, that we will bounce. You can see where the 3 green arrows come from. We finally dropped below the moving average. That's where we finally got the red arrow there. In fact, in 3 consecutive days, after weeks of not closing below the 8-day exponential moving average, in 3 consecutive days this week, we closed below the 8, we closed below the 17, we closed below the 30. Boom, boom, boom. In consecutive order there. So interesting that we weren't able to hold the 17-day, which is usually the case. But again, we went too long without breaking the 8. That was way too long. And now we've got some weakness where MACD and stochastics are both falling. They're both flirting with the midpoints of the chart, so we're not like excessively bearish here. But there's some weakness, and you'd expect that kind of short-term weakness to persist. When you look at today's intraday range, you can see after being bearish all week, starting the high of the week was at the open on Monday, and the low of the week was earlier today. We did bounce off of that and closed up above yesterday's low point. So not as bearish as we could have been. We closed at the high of the day, and we closed above yesterday's low. So it's still, lower high and a lower low, still a down day, but not nearly as bearish as it could have been, right? We could have been a lot more bearish there. So remember, we're going to have, when we have intermediate pullbacks, again, an example of the last intermediate pullback we had in the bullish trends over here, we had ups and downs, ups and downs before we finally busted up to the upside and continued the trend. So it won't go down every day, and we might see a little bit of a short-term bounce here, but I still expect that intermediate pullback to occur. You can see there's the anticipated Hakunashi open for next week, the purple line. So to get an upper shadow, to get both a lower and an upper shadow, right? We'll get a lower shadow here, but to get both an upper and a lower shadow, we'd have to trade up above that purple line. So it kind of gives you an idea of where we need to get to for us to not have a bearish weekly candle on the S&P. We are trading, even with this rally at the end of the day, we are trading the lower half of the range. That will stay there for another day. This will start to move up next week, day after day next week. That will just move this dotted line up along with it and will make us even further into the 4-week range. So, again, that doesn't mean that we're excessively bearish. It just means that there's some short-term weakness and there's going to be some ups and downs, but we're not close to getting new highs, 4-week highs, anytime soon, as of right now. If we take a look at the volume today and relative to its averages, and we still haven't filled in that lack of data points here, but you can see we had 85 million shares traded. The range today that we closed at 275.01 yesterday. Today's high was 274.65, so you had about a 40-point range, a 40-point overnight gap that we didn't fill in. So you have to add that to there. So we had about 260. So we're right about at the average. 85 million probably would be also right about at the average if we didn't have that decline. In fact, probably would be a little bit above average. Like this decline comes because of the 0 volume days that we had here, the lack of data. So the volume, if you look at other, when we were really bullish before, the average volume was around 57 million. Here the average volume was 77. We had 85. So we probably had a little bit above average volume on this down day. If you take a look at the volatility chart, you can see, we jumped up. We went from 13 all the way up. Here was Monday at the open. We opened up to 16, pulled back. We rallied all the way up to 18, which is good for our options inventory because we really in this level we focused on adding some positive vega trades to our inventory, and they have really helped out even with the pullback here at the end of the day back into the neutral zone. But you can see we are still not in that established bullish trend yet, which is when you get below 90 and hold that breakdown, that's when the volatility tells you we've established and we're stuck in this bullish trend, and we're not there yet. So the fact that we're still trading up here with volatility means that we can still expect some short-term weakness going forward from here. All right, with that being said, What do you think about that outlook? Do you agree or disagree with that? There's a poll popping out in the top right corner of your screen. As always, click that link, open up the poll, then hit either agree or disagree. If you disagree, because you see something different, then share with our community in the comment section below what you're seeing that either makes you more bullish, because again, we're expecting additional short-term weakness here. Maybe you think we've had it and this is the end of it. Or maybe you think this short-term weakness actually is will turn more back into potentially a bear market. So whatever you see, macro, technical, fundamental, whatever you're seeing that would suggest that, please share with our community there in the comment section down below. All right, now let's transition into what's driving the price action today and what our trade idea for the weekend. You can see the biggest winner of the week was long-term bonds. So long-term bonds rallied, yields falling. That's the result of prices rising. On the other end of the spectrum, look at IWM falling 4.5%. So small cap stocks, which have really rallied off of that low, giving back some of those gains. And really, as of right now, would only be that, giving back some of those gains. You can see emerging markets also had some good gains off of that low, also giving back some of their gains. If you look at over here on the right, here's all the other asset classes listed. We can't put all their lines on here to get really busy. But you can see, long-term bonds, there's 7 to 10 year, there's 20-year plus, all doing well. The dollar is also up this week. You can see crude oil finished the week with a positive move. Gold's also up there, even with the dollar rising. And you can see bonds in the U.S. as well as bonds in developed markets. Now, emerging market bonds pretty flat, and all the rest of these short-term bonds, municipal mortgage-backed securities, short-term bonds, all flat. Real estate, preferred stocks, kind of bond proxies, all pretty flat too. On the other end of the spectrum down here, you can see small caps, mid caps, large caps. Very broad-based selling. It's a risk-off week. Even value stocks and blue chippers were down quite a bit. There's your growth stocks, all underpacing. All U.S., all dropping more than the ACWI, which is the All Country World Index. International stocks outpacing just a little bit, especially developed markets. There's your dividend stocks holding up well. High yield bonds and commodities as a whole, with crude oil having a small gain on the weeks. Crude oil had a good week, had a down day to begin the day today, but then rallied and finished higher finished well off of its lows of the day, and that helped stocks kind of stop the bleeding. Remember, stocks have been very correlated to crude oil lately, and that rally helped stop the bleeding for equities early in the morning. If you take a look at what obviously was jobs report day today, that's the big number that came out. We had a big number, really the last couple of months we've had big numbers. Usually you'll see that here, but it's still showing the pre-announcement graphs at the bottom on Econo Day. But they beat the estimates. The estimates were 175, or excuse me, they came in well below the estimates. But when you average this number with last month, which was revised higher, then it ends up being right about at the consensus. So, big grain of salt there in terms of, this was a really outlandish move to the upside. This is a really outlandish move to the downside. Put them together, not really outlandish, right? Kind of matching what we're seeing. Unemployment rate came down, wages rallying up to from 3.2 up to 3.4%. So pretty good jump in wages. Housing starts kind of did the opposite of the employment. It had a really down number last month, but then was really up this month. So again, average those two together, and we're still continuing this slow decline in housing to the downside. Kind of disregard that sharp drop and that bounce back and put them together, and we're slowly moving our way down. Housing is a leading sector in the economy as a whole. So again, it will, even the last bullish market, it kind of peaked when the Fed stopped raising interest rates, is when the housing market peaked. But the stock market continued to move higher. It just rotated into the dollar sensitive areas like materials and energy. That's kind of what we're expecting again this year, and we'll see if that ends up being the case. Now the Fed's pretty much done, especially according to the futures market. The Fed is pretty much done raising interest rates, and you can see the odds for a rate cut actually jumping up today on that economic number. Remember, the GDP, which is updated today as well, is for the first quarter. The first quarter is typically the weakest quarter from a seasonality standpoint, at least lately. And it's expected to be 0.5, and it's not the first time. It's not the first time Q1 has been really weak. This was the weakest. First quarter was the weakest quarter of 2018, as well as 2017 here, and you can see weakest quarter of 2016. And then go all the way back here. It was actually pretty strong in 2015. But you can see, it can be and has been a weak quarter relative to the rest of the year. So I don't put a whole lot of stock into the fact that it's down to 0.5%, other than, it's a relatively low number. I've seen it down that low before without being in a recession. But in terms of economic surprise index, I mean, the fact that we're this negative and we're continuing to be this negative globally is going to put pressure on yields. So you go back to yields. Remember how TLT was up here this week. You look at how yields are doing. This is the 10-year yield, mind you, but look at the big drop. After we're trying to settle this base here, dropping back down. Look at the 30-year yield, testing that 200-day moving average after the death cross and not able to hold, bouncing pretty sharply down off of it. Those negative economic surprises and the lack of rate hike odds from the Fed will just continue to pressure yields. That will be bullish for bonds, and it doesn't necessarily mean it'll be bearish for stocks, but you can see which sectors will benefit from falling yields, and traditionally have been the utilities and the real estate sectors, not financials. They prefer a yield spread that's rising. In fact, if you take a look at the yield spread, it lags a couple of days here because we get the data from the St. Louis Fed. But you can see the yield spread's continuing its march. Well, here, let's go to a daily chart instead so we can see it a little bit better. It's been so low, and it's been kind of holding pattern here, even with the jump up in stocks. It's been kind of holding its pattern really close to a negative yield spread. In fact, if you see the 2 years in purple, you can see it's been pretty much rolling over and headed lower, and almost close to new lows for the year to date. And then the 10 years is black line. This is doing almost the exact same thing as a 2 year. And then, of course, the 30-year, which represents economic growth expectations. Also, it's a higher off of that low point, but you can kind of get an idea how they're all falling over right now, and that's going to be bearish for bonds and bullish for those bond proxies. Now, typically that can be also bearish for the dollar, and if I go back to a long-term chart here and look at the week for the dollar, we had a bullish week here, but it wasn't necessarily because of interest rate hike odds from the Fed. It was because all these other economies globally are more bearish than we are. Right, if you recall, EFA had it on the death cross and has failed at the 200-day moving average. EEM also on the death cross. It got further above the 200-day moving average, but it's now since failed and popped back down. So these international stocks are in more tenuous situations, and so the dollar has benefited from that. But look at that as temporary, because again, the dollar is more influenced by what the Fed's doing and the Fed's policies, and the Fed's also shifting towards being more bearish, and yields are falling, and the yield spreads, you would expect, our yield spread, which are much higher compared to Germany, Japan, you would expect that gap to be made up with our yields falling. That would be more bearish for our currency. So unless the dollar is able to break through kind of significant levels here right around 98, this kind of rally, we look to see whether or not that's going to be short-lived or not. Because if it is, obviously that would be bullish for equities, and especially bullish for international equities, and especially even more so bullish for emerging market equities. From a sector rotation standpoint, these have been updated. This grid has been updated with Brandon's current rankings on his sector selector tool, proprietary sector ranking tool that he's created here for market scholars. You can check our blog for the updated rankings this weekend. But you can see it's kind of interesting to see those interest rate sensitive sectors at the top, utilities and real estate, but also you see technology up there. In fact, with communication services, which also is kind of a mixture of interest rate sensitive and cyclical now with the changes, they're the only ones that are green, whereas everything else is red, which represents bearish postures, a falling market sentiment line. In fact, these market sentiments for all three of these are all above 80. So, I mean, 3 of the 4 are falling too, but they're above 80, so they're still strongly bullish. Everything else you can see weakly bearish, right? Industrials in the 70s, discretionary, staples, energy, all in the 70s. Really the weakest ones have been healthcare and financials. They've been the ones that are dropping below their moving averages. All have yellow moving averages or will have yellow, except for utilities and real estate and technology, which are all still up above, and communication services still up above their moving averages. But interesting to see a rotation, right? You had staples was up there. It's starting to move its way towards the bottom of the charts. Healthcare moving its way towards the bottom end of the chart. So there is a little bit of a rotation out of these cyclical areas. Still not of utilities and real estate yet, because remember they benefit from the falling yields. But in terms of relative strength, they can still be bullish. But if these cyclical areas, especially these dollar-sensitive areas, energy, material, and industrials, start to rally, they can rally more and push these interest rate-sensitive sectors to the bottom, alongside these other safe haven areas. So we're kind of seeing a little bit of we've had a really good returns in these safe haven areas over the long term, over the last close to a year. But now, in fact, if you go back on this chart here, let's go back to the sector comparison, and let's go back to the full year. This past year, you can see, I mean, you look at utilities and real estate, they've got double-digit returns. The market itself is flat from in the last 52 weeks. But those sectors, and you can also see for a while there, staples and healthcare had some outperformance as well. Staples pulling back, but you can kind of see which sectors have been underperforming and which sectors have been outperforming. And it's been these safe haven areas with these cyclical areas underperforming, starting to get a little bit of a rotation in those areas. So last time we looked at a bearish stock in the cyclical area. This time, here's another bearish stock in a different industry, but also a cyclical stock. This one in the retail industry, and that's Lululemon. You can see, it's the move it's had today, kind of breaking through some lows ahead of earnings. It has earnings coming up at the end of the month. That's a pretty bearish move on strong volume, relatively strong volume, 1.5 times its lowered average that it had. But if you take a look at some of these other indicators, breaking below or pushing down the lower Bollinger Band, getting down here, you can see kind of how we hit some resistance at the top end of the volume, very similar to what we saw on Micron. You take a look at the DMI for Lululemon and pull up its other DMI indicators here at the bottom. You get that crossover, the crossover, the negative over the positive, the negatives crossing above 25. You got negative indicators on these supporting. So bearish patterns. You look at this long-term view, kind of break it down long-term to short-term. You had that long upper shadow a couple of weeks ago. Kind of a big engulfing pattern of multiple weeks this week to the downside after a really sharp move to the upside. Before there's that last engulfing pattern we had on the weekly chart that led to some weakness here. You break it down to more intermediate terms here. You can see we have red. Let's go to the market forecast. Sorry, this is what I want to look at first. Then we'll look at the 3 red arrows. But you can see we got the dark pink shading combined with the red line. So as bullish as it is to get a dark green shading with the green line, here we have dark pink shading with the red line, and that can be just as bearish as that is bullish. Now let's look at the 3 green arrows, and you can also see that pink shading there too, because we have 3 red arrows and a falling moving average with strong volume on this little breakout move to the downside. And of course, looking at the 4-week range, and today setting in a new 4-week low after kind of holding this range for so long, like another bearish move. And go back to that weekly chart and look at the Hakinyashi really quick for Lulu. Here we go, Hakinyashi. And again, you can see the smaller, we had the bullish move, and you had some smaller bodies, and this week a smaller body with an upper and a lower shadow. Transitionary period, you would expect some more bearish candles to come out of it. We'll see if that ends up being the case. And so if that is, then we can look to sell. We don't be aggressively bearish, again, because I don't expect the market to be in a bear market. So I don't want to trade against the broad market as a whole, but I do want to take advantage of any potential weakness in the intermediate pullback in the broad market. So I can sell a call, at that 30 delta, sell the 155 call, buy the 160. Remember that I do have a maximum loss on this, $376. But remember also that my position sizing, I need to account for that earnings announcement as with any risk factor that's out there. You need to account for with smaller positions than what's normal. So maybe if your position sizing says, oh, with $376 max loss, I can normally do 3 contracts. Well, maybe we do 1 or 2 instead because of that earnings, just in case, because you don't want to take that $376 loss. You would much rather take. Here we'll do the single symbol. You'd much rather take a $124 loss, and so you can see to get that, we'd have to get up above this break even. That's at, where is it at? 156 and a quarter. Get up just a little bit more up into this area, 157 and a half. You set that slice here on the chart, and you can kind of get an idea of where we have to go up to. So we have to really make a move up to the upside, and just to get to the point where I take a $124 loss. So that's okay, right? I don't want to take the 376. I'm willing to take 124 because that's what I'm trying to get. And if I can get close to that, $62 gain, especially before earnings, then I'll take it. I most likely won't, but if I do in the next week or two, then we'll take that 50% before the earnings comes out and move on to something else. All right, so that wraps us up for tonight. That's what I had for you. Now it's your turn. Now let's keep the conversation going this weekend, and I want to hear from you and what you're thinking and what you're seeing in our Market Outlook forums. There's that link popping out there in the top right corner of your screen. Remember, you have to subscribe to our site to do that, but you can do that for free. I showed you how to do that earlier. Subscribe for free, and you can participate there. If you have any questions or comments from me about anything I discussed or anything I didn't discuss, you can put those in the forums on marketscholars.com as well. Remember, you can also reply to anybody else's threads. You don't just have to wait for me to reply. That's the point of a community, right? So you can reply to each other in that forum. As always, thank you very much for watching. Have a great rest of your weekend, everybody, and we'll see you all next time.